Joining me now is Kevin Mon, president at Hennion and Walsh. Welcome to the show.
Thank you, Ashley.
So we had quite an eventful session yesterday.
To say the least.
Yeah, can you break it down for us and tell us what you expect going into today's session?
Sure. Obviously, investors are grappling with a lot of information coming at them in short periods of time. We have concerns over an escalation between U.S. and China as it relates to trade and tariffs. We have the beginning of earnings season, which has started out pretty well so far in terms of what we've heard from the major banks thus far. We also don't know when the Federal Reserve is going to get new data to act upon as the government remains shut down. I'm still in the camp that if they get new data and if the government remains shut down until their next meeting at the end of this month, that next 25 basis point cut is all but assured. And then, of course, everyone is now questioning, is the AI bubble about to burst? And I think those waiting for that AI bubble to burst are going to have to wait quite some time and miss out on quite some investment opportunities along the way.
All right. And, you mentioned the Fed cutting rates. They cut them in September. It was more than 6 months that they took to cut those rates. Historically, what have we seen in situations like that? And what do you think will happen?
It's a great question. I think that provides another tailwind, believe it or not, for the equity markets. These same equity markets that have reached a new record close on 33 different occasions this year, following 57 such instances last year. But what Goldman Sachs study showed us was that over the last 40 years, the Federal Reserve has cut interest rates 8 times following a pause of 6 months or more, just like we saw back in September. Now, in half of those instances, the economy moved into recession. That's not our base case this time around. In the other half of those instances, well, guess what? The economy continued to grow, albeit at a slower pace, and the stock market moved on average 8% higher over the next 6 months and 15% higher over the next 12 months. I think there are more growth opportunities ahead. I think we're going to see more money coming off the sidelines in this fourth quarter after we experience some more short-term bouts of volatility. But investors will need to be a lot more selective to find those growth and income opportunities.
Where do you think the growth and income opportunities are?
Sure. I'll start on the growth side. Let's look to the AI ecosystem. We hear more and more of these circular AI financing deal. And what it tells me as a portfolio manager is the interconnected nature of all the big players within the AI ecosystem and how reliant they are upon each other. It also reminds me not to concentrate too much on any one or two names or one area of the AI ecosystem. So there's some names that we like right now that all benefit from the AI revolution. How about a company like IES Holdings? They supply the electrical connectivity to data centers. Their stock is up nearly 97% year to date. Or how about a company like Comfort Systems, ticker symbol FIX? Most participants in your audience member probably never heard of Comfort Systems. Well, guess what? Their stock's up over 100% year to date. They supply the cooling solutions to data centers. 2 companies reporting earnings this week, one this morning, ASML, the top lithographer for chip making, and then, of course, Taiwan Semiconductor, the largest dedicated chip foundry in the world. They report tomorrow, and I think they're going to knock the cover off the ball.
All right. And what are your other expectations for earnings season? What do you think is going to happen?
So right now, we're forecasting year-over-year earnings growth of about 8%. If, in fact, that holds, that will mark the 9th consecutive quarter of year-over-year earnings growth. That's certainly a positive. I think we're actually going to exceed those expectations based upon what I've seen already. The first half of this year, the consumer wasn't as strong as they typically are. Normally, consumer spending accounts for 70% of GDP growth. Through the first half of this year, spending on AI infrastructure actually matched the contribution of the consumer towards GDP growth. Now it's shifting back to the consumer again, and that's good for corporate earnings in the second half.
Are there any more growth opportunities that you see in the market right now?
Yes, I think one area to look to is biotech, small cap biotech companies, as there are many headwinds facing large cap pharmaceutical companies right now, whether it's pressure being put on their margins because of lower drug prices coming out of Washington, large revenue producing drugs coming off a patent and now being subject to generic pricing. All that's going to force them to be more acquisitive to replace all that lost revenue potential. And who are they going to acquire? Well, the innovative healthcare solutions of the small cap biotech companies. And that started to take place already, and we see more ramp ahead.
Any thoughts on small caps? The Russell 2000 was up over 1% yesterday at the close of the session.
Yeah, we've seen a lot of head fakes out of the small cap community thus far this year. Small cap biotech is certainly one area that I like. But even within the technology revolution area, look to players that operate in robotics. How about companies that operate in the Internet of Things or cybersecurity? I think there's opportunities in some of those smaller cap names too, but we need the Fed to continue to cut short-term interest rates for the small cap trade to really come back in earnest.
If the Fed does cut in October, what is your outlook for the economy based on that?
Sure. I think my economy is very different from the outlook from the Federal Reserve. As we learned in September, they believe that GDP growth will slow this year to 1.6%. I believe right now we're forecasting somewhere in the high 3% for the third quarter. That's very different. So does the Fed know something we don't know? And do they think the economy is going to slow materially in the fourth quarter? If they do, I think that actually assures the likelihood of 2 more rate cuts this year and perhaps 2 rate cuts next year, because the Fed wasn't anticipating as large of a shock to the labor market as we're now starting to see. For example, they weren't forecasting that nearly 1 million less jobs were created over the last year, as we learned recently. They need to change their calculus, which is why I think they're now more attentive to the employment side of their mandate than they are to the inflation side of their mandate, and that means more rate cuts may be on the way.
Is there anything that you're tracking that is under the radar right now that you think might make a big splash?
Complacency. I think investors are very complacent right now, as we've seen a record run for the bull market. I think they believe that's going to continue in perpetuity. In terms of the AI bubble, if you will, I think this is very similar to other phases of previous industrial revolutions. And investors shouldn't anticipate and expect this record amount of spending or these record amounts of growth rates to continue in perpetuity. So now's the time to diversify. Look beyond just the biggest players. Don't abandon them, but look to diversify into other areas that stand to benefit from the AI ecosystem and the AI revolution overall as well. But don't forget about the utility sector. I speak about the utility sector a lot. It's a boring sector, but utilities generally hold up well in the face of volatility. They pay good dividends, but now they've become a backdoor play into the AI revolution as well. Top performing sector year to date. So for many investors who think they've missed the gravy train as it relates to the AI revolution, perhaps consider utility stocks now.
All right, and how are you advising investors right now, given everything that's going on with the markets and the economy?
Yeah, as in any market environment, I recommend that they stay true to their risk tolerance, stay consistent with their longer term goals and objectives, and also their investment time frame. In other words, Ashley, your risk tolerance shouldn't move higher just because the market is moving higher and setting new record highs, just as much as it shouldn't move lower when we see more short-term bouts of volatility, as we will. Stay consistent to your risk tolerance. It's more important to be in the market than it is to try and time the market. Timing the market is an exercise in futility. So work with your financial advisor to build a diversified portfolio that you're comfortable with, that will help you meet your income and goal and growth objectives over the long term.
All right, Kevin Mon, president at Hennion and Walsh, thank you so much for joining us at the New York Stock Exchange.
Thank you.